last section, subchapter S. These are S corps. This is that hybrid that I was talking about. If a partnership and a corporation had a baby, it would be an S corp. Okay, so it's a pass-through entity, which means that just like a partnership, it does not pay income tax itself. It passes through its income and expense items to the owners. Now, they're not called partners for an S corp; they're called shareholders. Right? So they own actual shares in the company, but generally speaking, these are usually small businesses, usually mom and pop type of establishments. And unlike partnerships, owners of S corporations can be employees. So remember, with partnerships, the partner had to pay self-employment tax, right, on the income that they received from that partnership. Well, with an S corp, because you're an employee, it's not self-employment income, which means that you don't have the self-employment tax. Yeah, you still have the employee share of FICA, and yeah, the company is still paying the other half, but the individual doesn't have to pay that FICA tax anymore on their part. The business gets to pay that, and then it becomes a deduction for the business as well. So also, individuals have a lot more control over than what their taxable income is. Owners do. If they're a W-2 employee, they can say, well, I'm going to pay myself. Now, it's supposed to be reasonable. And this is one of those areas where the IRS would come in and audit these S corporations, because here's the advantage. If you're an S corp owner and you are working in the S corp, and the S corp is making $100,000 net income, and that's flowing through to you, and you're not paying yourself a wage, that $100,000 is circumventing Social Security and Medicare tax, because it's flowing through to your tax return as just ordinary unearned income. It's being taxed at your regular tax rate, but it's not being subject to Social Security and Medicare tax. If that were a partnership, though, that $100,000 would be subject to Social Security and Medicare tax. So you think you're really smart, you're going to form an S corporation, you're not going to pay yourself a wage, you're going to get that money, it's going to flow through to you. Yeah, you're going to pay income tax on it, but you're not going to pay any Social Security or Medicare tax. However, the IRS doesn't like that, right? So they will come in and audit S corporations to make sure that owners of S corporations who are providing services to the S corporation are paying themselves a reasonable wage. Now, if the company's not making any money, they can't pay themselves a wage. That's perfectly reasonable, right? But let's just say that company was making $100,000, and the services that the business owner was providing was worth $50,000 a year. They'd have to pay somebody else. That's kind of the gauge. How much would you have to pay somebody else to do that work? So $50,000 a year is what they should be making. The IRS would come in and say, you need to pay yourself a wage. W-2 wage of $50,000. Now $50,000 of that income is being subject to Social Security and Medicare tax. Yes, the employee owner is only paying half of it, and the employer business is paying the other half of it, but it's no longer sheltered, right? Yeah.
A C corporation can own a stock for S corporation.
So C corporations, we're going to go through some of no. So that's one of the restrictions on S corporations, is who can own shares in it. Okay, and we're going to go through that here. But that's one of the differences then between a partnership and an S corporation, and it's a big benefit. It's a big tax savings. If it would have been, those wages would have been subject to self-employment tax if it was a partnership. You look like you're going to ask a question.
Yeah. So I've had a friend who was actually posted on Facebook about this, and was asking for advice on like what the benefits would be from going from like a sole proprietorship to an S corp.
Well, that would be one of the benefits, is that right now, as a sole proprietorship,
Mm-hmm.
they're being taxed on all of their net income.
Okay.
If they form an S corporation, now there are more administrative requirements to do that. First off, you're a corporation, which means you've got to fulfill all of the legal requirements for being a corporation within the state. So you've got to have your annual board of directors meeting, even if that's just one person. You've got to file every year with the state, all of that stuff. Plus, you have to prepare then a separate tax return.
Mm-hmm.
Whereas with a Schedule C, you just get to put it on your individual return. But with an S corp, you're going to have to do 2 tax returns now, the S corp return and the individual tax return. But the benefit is that is the main benefit of it, is that owners can then pay themselves a salary that is probably less than what they were paying. How do I say this? Less than the amount they're probably paying less tax is the gist of it, in the form of Social Security and Medicare taxes.
Okay.
Now, but it still has to be a legitimate business, and it still has to be. And when I say that, I mean it has to have, like, if somebody is an Uber driver, let's say, and they're a sole proprietor. I mean, I suppose you could form an S corp. That's probably not a good example, because there are some Uber drivers out there that have, I mean, they've got like a legit business going. They've got all sorts of stuff going on. Some people just do it on the side, right? They're just doing it to pick up some extra income. If you're one of those people that's just doing it to pick up some extra income, it's not really a company, you know, then that might not be the wisest move to form an S corp. But if it's like it's a proper business and it has been functioning, then it's as a business, then yes, it is perfectly reasonable to switch that then to an S corporation. And you could have a single owner, one person that owns all of the shares of the S corporation.
Okay.
But that salary has to be reasonable.
Okay.
It has to be, you know, again, what you would pay somebody else to do the work. Now again, that all depends on if you've got the money. Like if your S corporation is making $10,000 a year and you would normally have to pay somebody $50,000 a year to do the work, well, you can't just make the $50,000 come out of nowhere. If you could, I wouldn't be standing here. And I don't think any of you would be sitting here.
So
either.
if he went to an S corporation, he would have to pay himself a salary.
Yes, if he's providing services to that S corporation, yes.
Okay.
You would have to pay. It doesn't have to be like a salary, like a set salary. It could be an hourly wage, but it has to be reasonable.
Gotcha.
And so in addition to that, then he would have to prepare a W-2 form. He would have to file 941 forms. So just like any other payroll situation, you'd have to do all of that stuff. So for very small companies, it may be not worth the administrative costs of it.
Okay.
But for some, it may be, right? All right, so S corporations, again, it's a flow-through entity. They get a K-1, just like the partnerships do, owners do. But S corporations also can have other employees, so they're, you know, that are not owners. They have the same year end as shareholders unless they get some special permission. I've not experienced any S corps that have a different year end. It's usually the calendar year, January to December. Due date is the 15th of the month after the end of the fiscal year. So if it's December 31st, due date of the S corp return is March 15th. Same day as partnerships, that gives owners a month to use those K-1s to prepare their own tax returns. Now, a lot of times these are extended. You can get up to a 6-month extension, but when the S corp extends their tax return, the owner has to extend their individual tax return as well, because they're going to be waiting on that K-1 to be prepared. S corporations have a lot of restrictions. It has to be a domestic corporation. Foreign corporations cannot be S corps. You have to have 100 or fewer shareholders that are all individuals, estates, or certain trusts. So a partnership cannot own an S corp. A corporation cannot own an S corp. Okay. Individuals include, how do I wanna say this? If it's a married couple, they're considered one individual. So really, you could have up to 200 individuals for if they were all married couples. But married couples are considered, two people are considered individuals. They can only have one class of stock, so they can't have like preferred stock, anything like that. All of the shareholders have to be US citizens or resident aliens. So again, there's no foreign component to the S corporations. You make an election to become an S corporation. So you're already organized, you have to organize as you could be a partnership and then choose to be taxed as an S corporation. You could be an LLC and choose to be taxed as an S corporation. You can be a sole proprietor and choose to be taxed as an S corporation. This form 2553 is what has to be filled out. It's an election to become an S corporation. And you can do it retroactively. You have to fill this out by the 15th day of the third month of the current year. So as of March 15th, so you're a tax preparer, you get a client that comes in, you look at their partnership, and you look at their income and expenses, and you're like, oh, you're gonna have to pay a whole lot of taxes here in self-employment taxes because you had all this income. Did you provide services? Yes. Well, if you wanted to become a S corp, we can go back to the first of this year, and you can start out then for next year as an S corp so that we can avoid all of this. Now, the IRS oftentimes as well would let you go back even further. So there were instances where we would request it's not really an extension, to go retroactive to the beginning of the previous year. So once you found out that they were in a tax bind, you could fix it. But then you'd have to go through and they've got to get a W-2 and they've got to do all that stuff as well. But that's value added right there. So S election is valid until it is statutorily terminated or voluntarily revoked. Statutorily terminated means that you have now violated one of these factors, right? Or you can volunteer, you can decide we're gonna terminate our S corp status. So just like with the partnership return, the S corp, we have ordinary income and we have separately stated items. Like I said, they get a K1 just like partners do in partnerships. And there's a basis. Basis with regard to, basis calculation with regard to S corps is complicated like it is with partnerships, okay? It has to be continuously updated all of the time. But it's your basis in the stock of it, not your ownership. So this is what the S corp tax return looks like. Again, we've got an income statement here. Looks very much the same. Lots of questions about who owns it. You've got all your separately stated items there in general, and then we've got our Schedule L, our balance sheet. How to make that smaller? We've got our M1. Same thing here, M1. This is an accumulated adjustments account. So you use these when it used to be a C corporation but became an S corporation. So there's some factors there that are, all right, there we go. Let's see. So, I mean, this is just an illustration of how, the total income between these two owners. And the ownership, like the income, everything has to be proportional with an S corporation. So you can't do any special, like you can't say, hey, Zeke, we're gonna give you an extra distribution. No, it's gotta be proportional. Tamar will have to get a distribution as well. Basis, same sort of concept here. Starting with net income, so we'd have our beginning basis like any other corporation. Add net income, add separately stated income items, add any capital contributions, amounts contributed by the shareholder, add any loans that the shareholder made to the corporation, and then we would subtract any losses, separately stated expense items, and any distributions from the corporation as well. So very similar to the partnership with that basis calculation. They don't, though, increase their stock basis by the share of debt, like we did with the partnership. Let's see. Go through all that. All right.
So review for this.
Yes.